$500 billion. We're not talking about a market cap or a valuation here. We're not even talking about a 10-year projection on a slide deck. $500 billion is the size of a financing package that NVIDIA just announced earlier this month. This is money that NVIDIA is assembling alongside 6 of the largest pools of private capital on the planet. And that's Apollo, Blackstone, BlackRock, Brookfield, Goldman Sachs, and KKR. All right, so I'm reading this, and you know what jumps out at me right away? NVIDIA doesn't need money. You know, this is a company that's generating something on the order of $50 billion in free cash flow in every single quarter. You know, companies like that usually don't need to go out and raise $500 billion because with $50 billion in free cash flow a quarter, usually they can handle, whatever they need to handle in-house. So guys, there are 2 ways to read this. Either something has gone very wrong and NVIDIA is scrambling for cash, or this company sees something big that it's getting ahead of at a massive scale. Now, I've read both the bullish and the bearish argument on the artificial intelligence or AI infrastructure boom. I mean, they are spending an obscene amount of money in capex, capital expenditures, to build these AI facilities out. And that's what NVIDIA is doing here with this $500 billion. So some people say that this is brilliant. Others say it's doomed to crash. We're going to see who's right. But I've come to see that there's a third thing going on here that nobody's really talking about. And once you see it, the whole debate about whether this is a bubble or not, well, it starts to look almost beside the point. And that's what I'd like to talk to you about today. Hello and welcome back to the Phoenician League podcast. I'm your host, Joe Withrow. So we're going to talk about this AI thing today. And let's set the table here. Right now, there is an argument raging across financial media about whether the AI buildout is the greatest capital investment cycle in modern history or the greatest capital destruction event since the dot-com bust. And both sides have a real case. But I think both sides also tend to overlook key points that the other side is making. And that's what makes this interesting. Now, I pride myself on being an objective analyst. I don't feel the need to rush in and take sides. And I don't feel the need to try to make predictions that maybe would make me look smart if I got them right. Instead, I try to assess everything objectively through a data-driven lens. So that's what we're going to do today. And then I'm going to show you the third piece that I don't really see anybody else talking about. All right, so let's start with the bear case. All right, the 4 biggest hyperscalers, which are Amazon, Google, Microsoft, and Facebook, which now goes by the name Meta for a very dumb reason. But these 4 companies are on track to spend somewhere in the neighborhood of $700 billion in capex on AI this year. Somewhere in that ballpark. And that's just this year. There are projections floating around out there that these guys will spend around $5.3 trillion combined by the year 2030. And that's just an insanely big number. Now, these companies are each very profitable. A chunk of this capex is coming out of their operating cash flow, but not all of it. Current estimates suggest that it's about half of what's being funded is coming out of cash flow. And the other half is capital that they are raising through other means, and largely through debt. And that's where it starts to get interesting. But when you need to borrow massive sums of money like this, a regular bank can't do that for you. It's got to come from somewhere else. So in June, NVIDIA went to the public bond market for the first time since 2021, and the company sold $25 billion worth of senior unsecured notes with durations that go out to 30 years. And NVIDIA followed that up with the $500 billion private credit partnership that I mentioned at the top of today's show. Meanwhile, NVIDIA has invested over $42 billion basically in its customers as of the start of the second quarter of this year, meaning NVIDIA is investing in the companies that are the biggest buyers of NVIDIA GPUs. And so this is called vendor financing. Many refer to it as circular financing. So NVIDIA is effectively giving companies money that those companies then turn around and use to buy NVIDIA's products. All right? NVIDIA is also organizing financing for these same companies to buy even more NVIDIA products. And that's where things start to get murky. Now, the bears point out that Lucent Technologies did exactly this with the telecom carriers back in the late 1990s. Lucent engaged in vendor financing really to boost its own revenue. But then its customers went bankrupt, and Lucent was stuck with bad debt, and it ultimately went bust also. Right? And then there's the securitization channel as well, which reminds me somewhat of 2008. So around $61 billion worth of data center debt has been packaged into securities and sold to investors. And that's just this year. So the idea is that these investments make money when the loans and the lease payments are made by the AI companies taking on the debt. And I think much of this is being sold into pension funds and some insurance companies as well. All right, so as another parallel, all of a sudden the ratings agencies are giving this debt strong ratings. Moody's has assigned AAA ratings in some cases, even though this market didn't hardly exist 10 years ago. And then just last month, the Securities and Exchange Commission, the SEC, it confirmed in writing that data center securitizations are not asset-backed securities. And that means they are exempt from the rules that Congress wrote in the wake of the 2008 mortgage blowup. All right, so if we put all those things together, I think we can see that the bear case has some merit. But there is merit to the bull case too. And it starts with the fact that these AI companies are generating real revenue. This isn't like the dot-com era where everything was about eyeballs, and future promise. But then most of the startups back then and the telecom carriers, they weren't actually making any real money. So no, we're seeing real revenue growth with the hyperscalers right now. They're all growing their cloud segment revenues near or over 40% right now, which that's very impressive, especially given how massive these companies already are. And then if we look at the backlogs, they have signed contracts where customers have committed to pay hundreds of billions of dollars for access to AI infrastructure over the next 3 to 5 years. To be fair, those contracts are not guarantees, but they do show that there is a market for what the hyperscalers are building. And some of these contracts require upfront payments too. So the demand is real, and that might justify the massive capex spending, right? This isn't a case where they are building infrastructure that nobody knows they want yet. As was the case with all the dark fiber, back in the early internet days. So the bull argument is that this capex is being spent against a contracted order book that is growing faster than the spending is. So from inside those companies, this does not look like speculation. It looks like racing to try to keep up with demand. And I think that brings up a good point that often gets missed. Debt is not always bad. If the debt is used to finance productive activity, and if it's used to drive economic growth, that's not really a bad thing. In fact, it's probably a good thing, right? So the bull case has merit too. And I should say in moderation, within certain constraints. But anyway, the bull case has merit. And the reality is that all of this infrastructure will continue to exist no matter what. And that brings me to the point that I want to make today. It is clear to me that Silicon Valley is all in on AI. It is clear to me that corporate America is all in on AI, right? It's clear to me that the US government is all in on AI. So there are these three massive power factions there that are each aligned, and they are all in on this AI build out. Are they right or wrong about that? We'll see. But this thing is not going to stop. And that's an investment insight. If you accept the framing that I've laid out, then we don't need to predict which companies will win and which will lose. We don't need to try to chase the right AI stocks and hope we can avoid the wrong ones. Instead, we can look at the big picture and we can just ask, what does the AI build out physically require? And if we answer that question, it may enable us to hone in on some key investment themes. So we'll start with this. AI data centers consume a massive amount of electricity. Most studies I've seen project that electrical demand will more than double by 2030. Now, despite what they tried to tell everybody 5 years ago, solar and wind power are never going to be a major component of our electrical grid. And by the way, Elon Musk knows that. Why do you think he's talking about launching data centers in space? It's because he could power a data center entirely with solar from out there, right? Where there's no atmosphere. There's no such thing as night and day, right? But coming back to Earth, these massive AI data centers, they need to secure sources of power that are much, much greater than the intermittent power coming from solar and winds. Okay, so right now, natural gas turbines are a big piece of that puzzle. In the near future, nuclear energy will be a big piece of the puzzle and probably the biggest piece, especially if we start to see working small modular reactors, which is kind of the next generation of nuclear power facilities, right? And that means the world is going to need a lot of uranium, right? Or uranium is the fuel that powers nuclear energy. Now, even if we produce all this electricity, it still needs to be moved and it needs to be transformed. And that means we need transformers, which means we also need switchgear, substations, high voltage cable, and numerous other hardware. And all of these things require a ton of copper. But copper is running a supply deficit right now. The mining industry cannot produce copper fast enough to satisfy current demand. So copper looks like a pretty good investment here, especially if you can identify an upstart mining company with real cost advantages, which is what we've done in the Phoenician League. And I suppose I should mention, all these data centers require a lot of buildings. And those buildings need steel, they need concrete, they need specialized cooling. There are probably some investment opportunities in those areas too. So if we look just at the physical inputs, the AI infrastructure race looks like a great investment opportunity, even if the bear case turns out to be correct. Because we won't know if it all goes bust until after most of these data centers are built. So guys, what if we just invest in the areas that don't require us to know the future? I found that to be a pretty good strategy. And it all comes back to the premise we launched the Phoenician League on. And that is, the age of paper wealth is over. That era ended in 2022. In this new era that we're in now, we need to focus on real money, real assets, and real strategy. So just to bring it home today, I don't know whether the AI build-out ends in a soft landing or a credit blow-up. I've studied the bear case carefully, and it has some teeth. I've also studied the bull case, and they are right that the revenue is there, and the demand is growing faster than the spending. In the present, there's no guarantee that continues in the future, but for the present, their case has merit. So I'm just in wait and see mode, and that's okay. Because if we focus on what we do know, we can still build our investment strategy to account for the AI race. All right, guys, it's a little bit of a short one, but that's what I have for you this week. I'll be back next week, and I think we may have another guest for you. I'll see you then. That's going to do it for today's episode of the Phoenician League. If you found any value in today's conversation, please subscribe to stay plugged into the network. We put out new episodes every week. And if something we talked about today made you think differently about money or investing, please leave a review and let us know. That helps the show reach the people who could really benefit from it. And remember, financial freedom does not start with money. It starts with understanding and a fiercely independent mindset. So if you would like to dive deeper into the topics we cover, I invite you to get on the Phoenician League email distribution list at phoenicianleague.com. We often send out detailed written analysis on the various investment opportunities in the asset classes that we advocate, and we connect the dots across what's actually happening in the global economy. And then we host online strategy sessions periodically as well, where we can really drill into how to take full command of your financial future. So stay connected at phoenicianleague.com. And until next time, let's stay smart and let's stay independent. This is Joe Withrow, signing out.